Imagine thinking you have 6 months and finding out on day 46 your exchange is already dead. Hi, I'm Sherry Ayland, CPA and tax advisor, and I help real estate investors legally pay little to zero taxes using my zero tax blueprint. Now, I want to go a little deeper in these next few videos and talk about some details on 1031 exchanges. This can be a very powerful strategy in order to grow your real estate portfolio and defer taxable income, as well as exchange out of more active properties at a time when you're ready to be more passive. In this video, I'm going to talk about some of the rules that you need to know before planning a 1031 exchange. An investor sells their rental property on January 1st. They find a great replacement property, but assume they have 6 months to close. On day 46, they're still shopping. The exchange is dead, and they owe $52,000 in taxes they thought they'd deferred. This happens more than you'd think. The 1031 timeline is unforgiving, and most people don't understand how it actually works until it's too late. So let's first talk about the two clocks. Number one is the 45-day identification window. This starts the day you close on the sale of your relinquished property, not when you list it, not when you sign the contract. You must also submit written identification to your qualified intermediary of the replacement property or properties. The identification must be specific. You need a legal description, a street address, or a distinguishable name. Verbal identification does not count. You can change your identified properties during the 45 days, but once day 45 hits, that list is locked. And just remember that there are zero extensions, not for illness, natural disasters, in most cases, or market conditions. Now, the second clock is the 180-day closing window. This also starts on the day you close on the relinquished property. This runs simultaneously with the 45-day rule, not after it. Here's a critical nuance. If your tax return is due before the 180 days are up, the exchange period ends on the tax return due date, or if you file an extension, the extension date. This catches people every year around year-end sales. So if you sell and close November 30th and don't file an extension, your exchange period may effectively end April 15th. That's 136 days, not 180 days. The next thing that you need to understand is you must have a qualified intermediary. The qualified intermediary is an independent third party. This cannot be your attorney, your CPA, your real estate agent, or anyone who has had a financial relationship with you in the past 2 years. They must be engaged and in place before you close on the sale. You cannot bring a qualified intermediary after the fact. They receive the sale proceeds from the escrow directly. They hold the funds, and then they wire them to the replacement property closing. You can never take constructive receipt. Even a brief moment where the funds could be directed to you disqualifies the whole exchange. Now, qualified intermediary fees vary based on the complexity of the exchange, but they are a small price to pay relative to your tax savings. Now, let's talk about the 3 identification rules. The first one is the 3 property rule. The 3 property rule is the simplest and most commonly used identification rule. You may identify up to 3 replacement properties of any value, and you must close on at least one of them to complete a valid exchange. That's it. There's no value caps, there's no ratio calculations, there's no math required beyond counting to 3. The rule doesn't require you to close on any specific number. It only requires that at least one of the 3 identified properties is actually acquired within that 180-day window. One other thing to think about is, while you only have to identify on paper your replacement properties, it's a good idea to have them under contract before the 45-day period is up. Next, we have the 200% rule. This is useful if you're looking at more than 3 options but want some flexibility. You may identify any number of replacement properties, provided that the combined value of all those identified properties does not exceed 200% of the value of the relinquished property that you sold. So if you sold for $500,000, you can identify properties totaling up to $1 million in value. That's the whole rule. One number. Your sales price determines one ceiling, twice that number, and everything you identify must fit under that ceiling, regardless of how many properties are on that list. So the first rule is about the number of properties, regardless of the value, and the second rule is about the value of the properties, not the number of the properties. Now, there is a third identification rule called the 95% rule. It's more of a safety net. If for some reason you can't end up satisfying the 3 property or 200% rule, then you have to close on at least 95% of the properties that you identify. In this case, you can have unlimited properties and no cap on value, but it's almost never practical. Here is a practical tip. Always identify the maximum number of properties you're seriously considering, plus 1 or 2 backups, so you can officially identify them before the end of the 45 days. Identification is free. Losing the exchange because your primary deal died is not. So, for example, using the 3 property rule, you close on the sale of the relinquished property on March 1st. Your 45-day identification deadline is April 15th. You identify 3 properties in writing by April 14th. Your primary choice falls through April 28th. You're already past your 45 days. Cannot add new properties. But you still have 2 backups, and you close on those before July 28th, which is day 149, well within your 180 days. Your full gain is deferred, exchange is complete. Now, in that scenario, if you had only identified 1 property and that property fell through, you're stuck paying your full taxes. When you can't defer 100%, boot occurs. And boot is any cash or value you receive from a 1031 exchange that you don't reinvest into the replacement property. There are 2 types of boot. The first one is cash boot. If you receive any cash from the exchange, say you sell for $400,000 and you buy for $350,000, you pocket $50,000. That $50,000 is taxable. Second is mortgage boot. If you sell a property with $200,000 in debt and buy one with $100,000 in debt, that $100,000 reduction in debt liability is treated as boot. Again, that is taxable. So to defer 100% of the gain, you buy equal or greater value and replace equal or greater debt or bring cash up to make up the difference. When you come away with boot, it becomes a partial exchange. Partial exchanges are still beneficial. You just pay tax on the boot portion and defer the rest. Doesn't have to be all or nothing. You just need to understand the tax consequences of that. So here are 3 takeaways to remember. Hire your qualified intermediary before you close. Identify your maximum allowable properties by day 44, not day 45, and file an extension if you're selling late in the year. Now that you know the rules, in the next video, we're covering the properties and structures most investors don't know qualify for a 1031.